Welcome to this week's Deal of the Week. Life 360 just wrote a $120 million check. And it could realistically add somewhere between $300 to $600 million to their company value. I don't want you to see this as a big tech, big company, big corporate private equity type story. I want you to see this as a pattern that you can copy as a low to mid market 7 or 8 figure business owner. I want you to stop thinking like owner operators and to start thinking like owner investors. Owner operators are always trying to tinker with sales and marketing, and they're doing it in a way that they're hoping they hit some sort of unicorn gold moment. Owner investors are asking and behaving in a different way. How do I leverage what I've already built to multiply the value of what I've already created? Now, there are 3 reasons why owner investors buy a business: new cash flow, new capability, and or new market. Sometimes it's just one of those, sometimes it's 2, sometimes it's all 3, but those 3 reasons are the reasons that owner investors buy businesses. So let's see how those 3 stack up in this deal with Life 360. Life 360 bought a company called Navito. Life 360 is a family safety location app. A lot of parents already have this on their kids' phones. It does sharing location, it does driving reports, safety alerts, etc. They are a multi-billion-dollar Australian company, and they have hundreds of millions of dollars in annual revenue. Navito is a private ad tech company that was founded in around 2010. They run native advertising and brand content platform. Now, if you're like me, that sounds like gibberish. So in plain English, here's what that means. They help brands get their content to show up inside of articles and feeds, while at the same time helping the publishers be connected to those brands. They sit in the middle. The brands on one side, the publishers on the other, and they're the pipeline between them. So that's what Navito does. Now, public estimations, because Navito's a private company, are that they're around $40 to $50 million a year in revenue. They probably have a few hundred employees. Because they're private, we don't know their actual EBITDA, but just based off of estimations of that size of company, it's probably 15 to 25. For our math, for this situation, we're just going to assume it's 20%. So what that means is that on a roughly $50 million revenue, that gives us about $10 million a year in EBITDA or profit. That's the data behind this story. So Life 360 is buying Navito for about $120 million. On that assumption, they're paying something like 2.5 to 3 times revenue and roughly 12 times EBITDA for that. So did Life 360 buy this for a new cash flow? If Navito's doing around $10 million a year in EBITDA, Life 360 just bought that $10 million a year into their business. They spend $120 million, and then the business is now going to spit off 10 additional million every single year for Life 360. So yes, this is a cash flow play. But was it a capability play? So before the deal, Life 360 already had a massive audience of followers. They have tons of users, tons of data. What they did not have was a full native ad tech stack. Because they purchased Navito, they now have the following. They have an ad server. They have better measurement and analytics data. They have relationships with premium publishers. They have a sales and operations team that they already know how to sell what Navito does. If Life 360 tried to build all of that from scratch, they would spend years and tens of millions of dollars and still probably be behind where Navito is today. So Navito has been in business for 15 years. So in Life 360's mind, this is a play to accelerate their ability to get something that they really wanted, a capability that they wanted in their business. So this is 100% a capability play, and it's 100% a move that an owner investor would make. Did Life 360 get into a new market with this purchase? Before Navito, Life 360's story was pretty simple. They just help families stay safe and connected. But with Navito, they can now have a secondary story. We are also a media platform where brands can reach families across a wider network of publishers. So now they're not just an app on your kid's phone, they're a potential channel for brand dollars aimed at families across the web. So they hit all three boxes here. They got new cash flow, they got new capability, and they got a new market. Now, outside of that, this is where a lot of owner operators start to miss. So what does this purchase actually do to Life360's value as a company? Now, I don't want to try and predict stock prices. I'm using this as a thought experiment. And I want to base it off those same assumptions around the data we had earlier. So right now, the public market values Life360 before the purchase at a high revenue multiple that's right around 12 times revenue. If Navido brings in around $50 million in annual revenue, once it's inside Life360 and the market keeps paying that kind of multiple, then the math looks like this. 50 million times 12 is about $600 million of enterprise value that's tied to Navido's revenue stream that's now inside of Life360. They spent $120 million on Navido, and that turned into about $3 on the low end, but probably closer to $600 million in additional company value in a second. That's called value multiplication arbitrage. And it's something that a lot of low to mid-market business owners, 7 and 8 figure business owners, don't understand. And so they don't get into the world of owner investor and mergers and acquisition because they don't realize the potential that brings to their own wealth and prosperity. So let me put it into your world. So you might be thinking, great, Justin, I'm not a $1 billion company. I don't have $120 million to buy someone else's business. Fine, I get that. But the pattern of what is happening still applies to you. When Life360 does a deal like this, they're trying to increase the value of each share for their investors. So instead of asking, will this deal give me more to do? They start asking, as the shareholder, what does this do to my personal payout? What does this do to our other shareholders' personal payout? Does this acquisition give me more reliable cash flow coming out of the business? Does it make the whole company worth more to a future buyer? Does it buy back my time? If so, can I now actually live the life that I want? Because the point is not just to add more EBITDA. The point is, what does that EBITDA buy you in real life? Is it more margin so you can hire better people? Is it room to do deeper and more meaningful work? Is it space to contribute more? Is it more presence with your family? Is it more fuel for whatever legacy and charitable or impact items you actually want to accomplish but can't because you don't have the time or money to do it? And those owner investors are thinking like this. If I buy this business, this capability, this IP, will it increase the value of my shares enough that my life outside of business gets better and bigger and more aligned with the life that I actually want to live? So when you look at the Life360 and Navido deal, don't just admire the numbers. Ask yourself, what is my version of this? What deal, what capability, what market would increase the value of my shares and move me closer to the life that I actually want? That is one of the primary ways that you can stop acting like an owner-operator and start playing like an owner-investor. This has been this week's Deal of the Week. I'm Justin D. Maxwell, and until next time, thanks for watching.